As early as spring 2014, the ECB may have the power to close banks that don't toe the line. It's part of a master plan to take the reins away from national supervisors, breaking the link between badly performing governments and the banks that lend to them, but also depend on them. Ministers from 27 countries have had some success reconciling concerns. Initially, the ECB will have no remit over German savings banks. Non-euro currency members can now block rules they don't like, and the earning power of the City of London is less likely to be damaged. But credit markets know that putting the ECB in charge won't make a difference until there are collective backup funds to call on.
What you need to establish is a deposit guarantee scheme, which means that if one of these banks does go bust, then it's financed not by a government bailing out the bank, which was of course another one of the problems that we're trying to resolve, but instead the funds come out of this central resource.
All the more reason, say analysts, for the new supervisor to make a start.
The peripheral banks are suffering deposit flight. This is because investors know that €1 in Spain is worth less than €1 in Germany, for example, and therefore they take their deposits out. As this happens, the banks in Spain and Italy have to raise deposit rates to try to keep the money there. And they also raise loan rates to remain profitable. And this results into firms starving for cash and then defaulting. Ultimately, the liabilities go back to the sovereign, which recapitalizes banks.
The Governor of the Bank of England once memorably remarked that banks are global in life, but national in death. Even with all the legal framework in place, achieving a working banking union is going to require enormous concessions from all concerned. But without them, European Monetary Union could be stuck in its present unstable state. Nigel Cassidy, BBC News.